Hi, and welcome back to Atlas Crossings. Today, we will have a look at investment objectives and what to consider when setting investment objectives. We will also discuss asset allocation, portfolio structuring, and review. Let us start by briefly defining funds management. Funds management is the professional overseeing and handling of financial assets on behalf of a client. This client can be a retail or institutional investors. Institutional investors including pension funds, insurance companies, private companies. Fund management can include several aspects around managing a client's cash flow and buying and selling assets within a portfolio. But it can also include managing a client's budgeting and tax needs. Fund management sees that funds are pulled together from various clients and then put or invested in the range of securities. There are several securities or assets that can be invested with a pool of funds in the fund management industry. A successful fund or portfolio is built on the client's and portfolio's investment objectives. Every investor starts on their investment path with a specific purpose, a goal that acts as a guiding star in their financial endeavors. One of the fundamental considerations that occupy the minds of investors is the need to grow their wealth, enabling them to meet their financial obligations and aspirations. These investment objectives are not mere abstract concepts, they're the compass that actually directs the course of your investment decisions. Two primary objectives that will significant influence our income and growth, capital growth investment objectives. The income objective is similar to the basically cultivating a financial plantation that yields fruits regularly. Investors pursuing this goal seek to generate a steady stream of income, typically in the form of dividends, interest, and yields. It's like planting seeds that bloom into periodic returns, providing reliable source of financial sustenance. On the other hand, capital growth or capital appreciation is similar to nurturing a robust financial tree with an eye on its long-term expansion. Investors with this objective aspire to witness their wealth grow over time. This pursuit involves a keen understanding of market dynamics, forecasting, and strategic stock selection. It's about identifying the right stocks at the right time, fostering an environment where your capital thrives and flourishes. So whether you're aiming for a steady income stream or nurturing your capital for future growth, understanding and aligning your investment objectives is the cornerstone of a purposeful and strategic approach to wealth management. There are essential factors that drive the overall formation of investment objectives. They include the following. Risk. One of the principles of finance is that the higher the risk, the higher the returns. Many investors believe this and expect that if they take a higher risk, then it should be worth it by receiving a higher return. Investors who are looking for safe investments with low risk will be more attracted to assets such as treasury bills and federal government bonds. As their risk appetite grows, their expectations of yield grow also. Time period of investment. Investment time periods can vary widely and are influenced by individual financial goals, risk tolerance levels, and the nature of the investment itself. The time period of money or the time period of investment is the duration for which an individual or entity commits their funds to a particular investment vehicle. It's essentially the timeline during which the money is engaged in a financial endeavor, be it investing in stocks or investing in bonds or any other investment assets. Short-term investments typically span a few days to a few years and are often associated with lower risk. Medium-term investments may cover several years, offering a balance between risk and potential returns. Long-term investments, on the other hand, extend over many years or even decades, aiming for substantial growth and often weathering market fluctuations. Picture it as a journey where your money embarks on an expedition through the ever-changing landscapes of the market. For instance, if you decide to invest in a stock or a fund for a specific duration, let's say 5 years, that time frame becomes your investment horizon. It's like setting a compass for a specific destination with the understanding that your financial vehicle will navigate through market highs and lows over that period. Now, why does the time period matter? Well, it's not just a random number. It's a strategic decision tied to your financial goals. If you're planning for a retirement in 30 years, for example, your investment horizon might be longer, allowing your money to go through the storms and benefit from the market's long-term growth. Conversely, if you're saving for a short-term goal, like a down payment on a house in 3 years, your investment horizon is more condensed. You're looking for opportunities that are actually aligned with your shorter timeline, emphasizing stability over the roller coaster of high risk, high reward ventures. Another factor is liquidity. Liquidity stands as a crucial aspect in the financial landscape, representing the ease and swiftness with which assets can be easily traded, sold, or converted into cash within that market. It serves as a barometer of market efficiency and accessibility. When an asset possesses high liquidity, it implies that it can be quickly converted into cash without significant price fluctuations or loss of value. When an asset possesses high liquidity, it implies that it can be quickly converted into cash without significant price fluctuations or loss of value. Imagine you hold shares of a well-established, widely traded company listed on a major stock exchange. These shares are considered highly liquid because at any given time and every given moment, you can swiftly sell. And you can sell them on the market without causing a significant impact on their market price. Suppose the market conditions suddenly change and you need to raise cash urgently. Having liquid assets like these shares allows you to quickly convert your investment into cash without incurring substantial losses. Ethical considerations in investments are not just about financial gains, but also about aligning your principles with your portfolio. If your ethical compass firmly points away from supporting companies involved in practices like child labor or fraud, it becomes a defining factor in your investment decisions. Investing in alignment with your ethics is like selecting companies that share your values. It's about putting your money behind businesses that not only aim for financial success, but also prioritize social responsibility and ethical practices. By excluding companies associated with child labor and fraud, you are sending a clear message that your investments are a reflection of your values. This approach often involves conscious decision making, where investors actively seek out ethical investment opportunities and avoid those that compromise their principles. It's a way of contributing to a more sustainable and responsible business environment, encouraging companies to uphold ethical standards. The debates of where to invest, domestic versus international investment debates, is akin to choosing between familiar terrains and uncharted territories, each with its own set of opportunities and challenges. The consideration of emerging markets adds an intriguing layer to this decision-making process. Emerging markets, often characterized by rapid economic growth and development, have the potential to yield higher returns compared to more established markets. These markets may offer untapped opportunities and prospects of substantial gains. However, it's essential to note that higher returns often come hand in hand with higher volatility and higher risk. Sharia compliance adheres to the principle of Islamic law, known as Sharia or Islamic finance. In the context of investments, this approach ensures that financial activities and products align with Islamic principles, avoiding elements such as interest, excessive uncertainty, and investment in businesses that involve prohibited activities. In Sharia-compliant investments, profit-sharing arrangements and ethical considerations play an important role. Instead of earning of interest, investors often engage in profit and loss sharing agreements, emphasizing fairness and risk sharing. Investments in industries like gambling, alcohol, or pork-related businesses are avoided, as they are considered incompatible with Islamic values. Last but not the least is tax. When contemplating investments, savvy investors put on their tax accountant hats, asking crucial questions. Will my investment decisions contribute to minimizing my tax liabilities? Certain investments come with tax advantages, offering a strategic way to navigate the complex landscape of tax regulators. For instance, some investments may provide opportunities for deduction, credits, or tax-deferred growth. This means that beyond the inherent financial returns of the investment, there's an additional layer of benefit in the form of reduced tax burdens. Equally, without careful consideration of the tax implications, investors might find themselves in a position where the gains are eroded by taxes, impacting the overall profitability of their portfolio. So once the investors and fund managers have identified the investment objectives, the next thing to consider is what assets fit the investment objectives and how they could be used to design a portfolio.